Good afternoon, everyone, and thank you for waiting. Welcome to our earnings call for the first quarter of 25 at Grupo Casas Bahia. I'd like to highlight that if you need simultaneous translation, we have this tool available on our platform. To access, please select the interpretation button through the globe icon on the bottom part of your screen. Choose your language of preference, English or Portuguese. For those listening to the earnings call in English, you have the mute original audio option. We'd like to let you know this earnings call is being recorded and will be provided on the company's IR website at where you can also find the full earnings release material. You can download the presentation as well on the chat icon in English. During the call, all participants will have their mics off. Soon after, we'll begin the Q&A session. We'd like to highlight that the presentations and possible statements during the earnings call related to business perspectives, forecasts, and operational financial targets in the company represent assumptions and beliefs of the company's management, as well as information currently available. Future statements are not a guarantee of performance. They involve risks, uncertainties, and assumptions that refer to future events and thus rely on circumstances that could or not occur. Investors must comprehend that economic general conditions and market conditions, as well as other operational factors, could affect the performance of the company in the future and lead to results that differ materially from those in such statements. Today, we also have the presence of Renato Franklin, our CEO, Elcio, the CFO and IR, and Gabriel Sucre, the Investor Relations Director. And now we'll pass on the word to Mr. Renato Franklin. Good afternoon, everyone. It's a pleasure to be with you to talk about the results in the first quarter of 25. Before we get into highlights, I want to reinforce that we're in a quarter that really provides evidence on the strength of our transformational plan. We began the year of 25 with solid growth, and now we've had profitability in our expansion that's expanding and a lot of operational discipline. The consolidated GMV has grown 10% with an important highlight for the physical stores, 17.7%. Significant performance above market levels. If we look at the GfK numbers and market share numbers in all core categories of the company, has kept leadership and expanded market share. Our EBITDA went up 47%, reaching a target of a margin of 8.2%, and it's the sixth quarter consecutively of this evolution. Over here, we don't want to talk about our beautiful building only, but besides the operational advances, we also have the buy now, pay later that grew a lot. And we've also been controlling delinquency with a more conservative approach. But we know that the market's keeping an eye on the bottom line of the company. The net losses remain, but the turning point is clear, and it's going to involve 4 different initiatives. First, we'll start capturing the operational leverage, more sales, diluting our structural costs, and making it possible for operational margin expansion. Then the reduction of our debts with many levers. There are 2 I want to highlight. One is the potential conversion of the debt into equity. And the second is the monetization of the tax credits that have contributed as well to improve the company's capital structure. The third is an improvement in the risk perception. So when we work with the operational leverage and reduction of the debt, we improve the risk perception, making it possible to reduce the spreads of working capital debts and other operational financial operations that impact our financial results. And last but not least important, we have the expansion of services and the buy now, pay later with greater margin and more stability in the company. Having said this, it's a moment where we're going to continue to deliver consistency, discipline, and execution Transformation is underway. Results are coming. Everyone's seeing this, and obviously, we're confident and aware of this delivery quarter after quarter to really put this company back on a growth cycle. Thank you for your presence. Let's start with the presentation here. First, we had growth of almost 1 billion in the total GMV, 6 quarters consecutively, an improvement of the EBITDA margin with operational leverage, and buy now pay later growing with a 6 billion portfolio. The first quarter has no Black Friday or Christmas. That normally helps us more in the fourth quarter, but we saw an 18% improvement in the delinquency and NPL rates, which is such a challenging moment in a macro environment with a flat, pressured demand and consumer capacity is really pressured downwards because of high interest rates that impacts the installment values, which is so relevant for our target audience. We can move on. We'll talk about the GMV a bit more. So you can see the total GMV growing in the physical stores by 16%, and the same store sales keeping up the base of the fourth quarter in 24. Very strong growth in our physical stores with a gain of 1.6 percentage points in market share. So the special sales we had in the beginning of January was a full success. We were able to gain market share. In January, we published an important relevant event, and before I used to deliver a quarter or and a month that was better than the other, but here the market's stronger in January, and we were able to gain share in February and March, and we saw demand dropping a bit. In April, it was the same trend. We saw demand a little weaker, and I thought that with the increase of the interest rates, we would have more pressure, but I think by the end of the month of April, this resumed, and May has strong demand as well. So we can really have a strong second quarter, but we have kept our eyes open, and we are aware that the interest rates increase consumption capacity, and in our perspective, we must be conservative, as there are some big chances of having consumption setbacks, and we're prepared for this, gaining share. Online, which this is a little smaller. In the first quarter, we still had a bit of non-core categories, but in the second quarter, we have more expansion online, and that's already clean from all the non-core categories, so the comparison will be easier to really view the growth in the core categories. And then 3P, we have a strategy with discipline in the mix of products, increasing the assortment of 3P in core and complementary categories, and we're growing about 15%, with revenue going up 17.5%, contributing and for the improvement of the ecosystem's profitability. So the buy now pay later is really one of our most profitable businesses in the company, and we always highlight this. Even with seasonality, the over 90, which is the first indicator, was 8.5%, in line with what we had last year. And this also drops. So in the first quarter, the production's already been normalized, equivalent to the third quarter of 24. And we have 8.5%, which is better than the issue of the company, and as a result of our conservative approach to credit granting and NPL, it's pretty much the same. Our provision is in line with the other three, and the fourth quarter of 24 had very strong Black Friday production, which ended up kind of diluting these indicators. But now in the second quarter, we're challenging ourselves to try to repeat Black Friday with May, Mother's Day. We've really worked hard to improve this indicator, but April and May are months that really don't compare with December. The seasonality of this in the fourth quarter was one of the strongest. Then we have the second, first, and third. Net debt is dropping, demonstrating our conservative approach, and production of 2.2 billion in line with the second and third quarters last year. I'll pass the floor on to Elsie to get into this highlights, financial highlights in the company. Thank you, Renato. Good afternoon, everyone, for your presence. Thank you for your presence. This quarter was another chapter of a consistent strategy we've worked on, the discipline and execution of our transformational plan. Important to highlight that our focus is in the key categories and the physical stores, the buy now, pay later, and services, thinking about how we can improve profitability and cash flow. Moving on, Renato highlighted some different points, and this is a slide we really like because it demonstrates the evolution of our transformation plan when we announced the plan by August 10th, 23. And in the upper left graph, Renato's mentioned the revenue 10%. GMV is growing about 1 billion, led by the physical stores. Financial solutions grew 18.4%. Buy now, pay later, and financial solutions grew. Online overall grew 2.6%. And with the increase in the take rate by 0.4 percentage points, reaching 12.7%. But the most important is probably the quality and results of this revenue. We've always talked about how this transition in our strategy was really based on the growth of the revenue and how we can translate the revenue into profitability for the company. So to start off with the upper right graph, you have the gross profit advancing 2.1 billion, growing 11%, an advance of 0.2 percentage points in the gross profit. Despite the growth in the revenue, we had an increase and an impact in the share of cell phones in our mix, which brings an average margin that's a little lower than the average in the company. But even with this expansion of this share in cell phone sales, we were still able to advance in the total gross margin by 0.2 points. On the left bottom side, you can see our expenses growing 2.6% in this period, way below the 10% growth in the revenue, which provided for this reduction in SG&A of 1.7 percentage points. So this performance demonstrates the gains in the operational leverage we've been talking about a lot. If you go back to the same slide on the third quarter last year, where revenue was stabilizing and we were growing in physical, but online was still dropping, we would say that we had important operational leverage potential. But now, after 2 quarters, we can really confirm and verify a bit of this. And our expectation is that this trend should remain in the next quarters as we're prioritizing our growth and profitability within key categories, executing our core in the transformation plan. We're really focused on managing costs and expenses. This is an important point. It's really essential, and we're going to continue to tighten some screws here and there. Maybe not at the magnitude we had with such drastic moves in 23, but in April we advanced with the closing of 21 stores, that performance below what we expected it should be, and we'll refine the costs and expense structure, making this operational leverage be even more evident, and so that we can advance and improve margins. The EBITDA reached 570 billion reais, and after highlighted about 47%, margins went up to 8.2%, significant peak of 2.1 percentage points, and the 6th quarter consecutively an improvement. So besides a robust peak last year, sequentially, we've increased by 0.2 percentage points, and that's how we've been advancing as we transform these initiatives and they mature gradually. We'll also see this be translated into our results. Next slide, please. Here you can see the P&L. We've already considered the main topics, but maybe some details. So other expenses, 19 million. You can see in the last quarters, values were a lot higher, but the adjusted EBITDA in this quarter really is very close. So this is how we would like to proceed from now on, and we'll keep up with these trends. But the idea is that we should not have any big discrepancy between the pure EBITDA and the adjusted EBITDA. That requires a bit of restructuring, and I want to mention financial expenses as well. 922 million pressuring our results, our net results. There's a Selic component we all know as well. But comparing with last year, major growth. But I want to highlight two aspects that are non-recurring and non-cash, and that impact this variation a bit. The first quarter last year, we've had a non-recurring effect, a non-cash effect of 200 million positive in the monetary update of the tax process and lawsuit. So we had a 200 million one-off effect in this line. And in this quarter, the non-cash, non-recurring impact of the debt, which was negative by 104 million. So if you exclude these monetary adjustments and the modification of the debt, and you can see a metric of the financial results as a percentage of the revenue. In this quarter, it would be about 11.8% versus 11.5% in the fourth quarter and 10.8% in the last year. So there was an increase really due to the increase in Selic rate, marginally greater than the fourth quarter, but just want to mention the context. When you look at the variation year over year, the impact seems very big, but if you normalize this, when these two effects, gradually it goes up, but essentially it's at the same levels. With this, the profits after income tax are negative, and you can see this result. Let's move on to the next slide. Two very relevant components in the company's cash flow. On the left side, you have the labor claims, significant reduction ongoing. And we've been talking about this ever since the transformation plan, where there's an amount of legacy processes that are really expensive. But as we pay them, we have a cash outlet. But as they finish, we see the new ones that have an average ticket and that are maybe a lot lower than the older ones. So we have the sequential improvement, 137 million this year compared to 216 last year. Very significant reduction, and it will continue to benefit and improve compared to the previous periods for the next quarters when you consider the legacy processes as well, with older management and very solid governance as well for these processes. And on the right side, you have the tax monetization, which is something that's been going on over the past few years with the peaks in ICMS. We reached 4 billion. We are wrapping up with about 1.9 billion reais in the first quarter. And we've also launched a relevant event 2 days ago with about a judicial claim in ICM. But within the 1.9, you have 632 million from the court decision, where we're going to start implementing different measures to start monetizing now. So it'll reinforce and keep up with our plan to evolve and transform the assets that are in our balance sheet into cash, and so that we can continue to advance in our capital structure that Renato mentioned. I think we can move on to the next one. When it comes to the cash flow negative, free cash flow as well, 322 million reais, which is due to working capital consumption. Within this, minus 600 million, you have a part which is supplier related that was already expected, since you have to pay a lot of what you've bought last year in the fourth quarter for Black Friday and Christmas. But you also have a strategic recomposition of the stock in Mother's Day. But Part of the sales are slightly smaller than what we expected in February and March, and this temporarily impacted our free cash flow. But as this happens, and it's adjusting, as we mentioned, but the fourth quarter and the first quarter are correlated, considering the seasonality, with the total sales of Black Friday and Christmas. And when we have the receivables, but the payments to suppliers are always in the first one. So from this perspective, when you compare this, and you always say the fourth quarter needs to be close to the first quarter, and one you pay, the other you make money. And when you look at the combined results for 6 months, we've got 917 million. If you compare the first and fourth quarters, and you see it's better than last year. So despite the first quarter being worse, more negative this year, when you combine with the fourth quarter, which is a combination, we're doing better. But having said this, we must continue to improve all of our levers for cash with monetization and labor claims, stock expenses. We always must have a very close look on the stock management, and that's the heart of our business. Next slide. Here you have our maturity schedule and liquidity. So we have the extended profile of our debt, and we have the 10th issuance with the second series of 1.56 billion reais, convertible to a company stock from April this year on. And I want to remind you that the price of this conversion, which is going to be based on an average of 90 days prior to the conversion date with a discount of 20%. And this is an optionality for the banks in this kind of conversion. According to the methodology, the leverage ended at 1.2 times, way below the contractual limit of 3 times. So thank you all, and I'll send it back to Renato. Thanks, Elcio. Next slide. We'll head to our final messages here. So we really deliver a quarter with a lot of highlights. We're delivering what we intended to do. Growing with profitability, focus on the use of capital and discipline, and we've been accelerating our buy now, pay later and improving our mix of products. Our net income is pressured, but the turning point is coming, and as I mentioned, in this capital structure, we'll also have contributions of operational leverage, reduction of our debt, monetization of the assets, and ongoing improvement of the risk perception about the company to reduce the spreads that are really high still, so we can have financial expenses that are compatible with the EBITDA margin we're going to be delivering with the leftover of net income to reach a growth cycle again. Next slide, please. When we look up ahead, what are we seeing? Well, for 25, this is a year where macro is still super challenging. High interest rates really affect the value of the installments for customers. So when we sell, our important lever is to grow the physical stores with the buy now, pay later offering, and this becomes a little more challenging. But even so, we've been able to have a profitable buy now, pay later credit offering, and we want to continue to grow our penetration of digital. Today, we've been able to have the same delinquency and net loss as the physical store. The challenge here is to increase the ticket, which is still really low in digital and in the buy now, pay later, to be closer to the physical stores, and the average term will help us have better returns on this capital and help continue to have these levers for cost control and expenses and monetization of the assets, besides the capital structure discussions, which will allow us to continue to have the adequate structure for this company. We're confident with this plan, confident about our execution and the addressable challenges to be able to reach the end of the year as we would like to, with another company shape, allowing us to start 26 with a growth cycle. So thank you, everyone. We're going to start up with the Q&A session. Thank you, Renato. Good afternoon, everyone. And before calling on our first question, I want to remind you all that if you have questions, you should raise hand. First, I want to call Daniela from XP. You may proceed. Good afternoon, guys. Thanks for taking my question. My question is focused on growth, and it'll have some overlaps in the sense. I want to hear from you guys about how you see the evolution of this growth. You can give us some color on this, but also about the demand at the stores. As also mentioned, also, you had maybe February and March that was weaker, but you said April's helping us reach the target already. So if you could give us some color to understand if there was some effect. Another point we also think an important leverage is the credit issue. And we want to understand what your appetite's like. We know there's still some room for improvement in the main indicators year over year. But when you look at this versus the fourth quarter, you have some metrics that maybe worsen a bit. Want to get a feel of how you're seeing this. We see some companies talking about a reduction in the credit appetite due to the macro context. And we want to understand your view on this, which impacts growth and on competition. How do you see the competitive scenario? That would be important to get an update on. And then the brand mix as well. I imagine you have more of the service mix helping with the margins, but if you could talk about the issue with the new brands you're attracting, which are being very successful, but they also bring in a lower average ticket, no? The Chinese brands. So how can we imagine this impacting growth since you have an average price that's lower? So there's growth with different overlaps you should cover. Hi, Denny. Thank you for the question. There's a lot of points to discuss. It's a question. It's almost a report. But I'll try to be objective and feel free to come in with any feedback as well. Well, what we're seeing is that it's hard to foresee how the market will operate in the next month. We have been choosing to be more conservative. So just about this conservative approach, answering part of this, we've been reviewing the credit parameters ever since October last year. One, because we have the seasonality in the first quarter, which is where consumers have more of a difficulty to pay off their expenses because they have other commitments. And then also, due to our perception of the risk of a possible recession, we're not sure how much, but possible unemployment that could exist as well. If we're going to reach this point or not really depends on if the government's going to create the incentives and the measures to avoid this. But high interest rates tend to lead to reduction in investments, and that would, of course, impact consumption potential in families. But we changed our ratings in the buy now, pay later. So we're a little more strict on granting, but on the average, it gets a little worse because of the macroeconomic factors. So when we look at the average results, the strategy was successful. We produced less, of course. We were talking about 950 million a month, but we went back to 300. But we preferred to not have this kind of risk and continue to be conservative, right? But when we look at an up and later, the worsening is only due to the production of this. All the rest is moving along according to what we have planned as a target. Maybe even a little bit of an improvement in the short-term indicators. And we already see this a bit beforehand to understand what the over 90 indicator will be in the next quarter. So we're quite conservative, but I wanted to mention this because it shows a bit of our market opening. And if this call was a month ago, I would be a lot more tough on this, right? We had to be a little stricter on costs. We closed down another 21 stores, and interest rates that are higher make some stores difficult to profitabilize. So typically, these are shopping mall stores that we close down, where you have buy now, pay later, penetration is very low, a reasonable sales volume, You have stores that make like 3 million reais per month, but a big concentration of Ponto Frios, and a bunch of them are in Rio, and 8 Casas Bahia, and about 14 Ponto Frio stores. When I look at this, we're really choosing the customers that can give us more returns. High income customers that buy in shopping malls are only going to work if they buy on e-commerce, have a break even. It's difficult to generate value with these customers. We need to sell where we can have the buy now, pay later and ad services. Up ahead, what we're seeing is May's strong. Ever since the 27th of April, it was already pretty strong. 28th was also strong. We had about 10% below plan, but May is also strong, and we'll recover April. So when we look at the second quarter, May will be more similar to January, that was strong. April will be like February, and we're still not sure about June, if it'll be better or worse. Because March had Carnival, so June should be a little better actually, but we have no date. That's like a special date for June, right? For commerce, we always have to work on initiatives for retail. If you see me on social media, you know how much we make an effort to capture customers in many different creative ways. We've been successful in this strategy, and we believe we'll continue to gain share and deliver performance that's significant. Second quarter, as you've already seen in the half of the quarter, we're convinced that the operational numbers will once again have an improvement and an increment demonstrating our execution. Second semester, well, we have to wait and see, but we're working to overcome the semester last year and reach the optimal point, but challenges are bigger than in the first semester. We're aware of them, and we have a very well-addressed plan. The leads leverage is also responding very well. This is an important leverage that will help us in moments with low seasonality, where salespeople have more time to work on these online leads, bring customers into the stores, improving productivity as well. So these tools with basic AI are providing very positive returns. Getting back to the brand mix, the main impact is in the gross margin. So you can see it's already incrementing this, but in the gross margin, when you look at the growth of phones sales, it's less margin than other utilities and furniture, but we're growing a lot in phones, which was not something we expected that much because of the penetration of insurance for robberies, and then that's why I can profitabilize this a bit more, and it makes sense to accelerate our growth. It helps with operational leverage and also helps with the EBITDA and EBIT margin. In the gross margin, it impacts us down a bit, but we have to explain this, right? Since you see this in a consolidated manner, it's not always a good indicator, but when we lack others, we use it. Our main challenge is not the commercial execution. We understand the scenario is tough, but we'll be able to do this. It's more about the capital structure levers that are well addressed, and we're confident about the execution. But of course, they rely on external agents and negotiations that are more complex to be able to become concrete and reach the end of the year with another capital structure and operations very efficient and profitable, and of course, unleash the entire potential the company has. I hope I answered that one. Just wanted to reinforce one point. Hi, Danny. Good afternoon. Thanks for the question, but over 90 for the first quarter and about 8.5%. There was this impact with the inflation compared to the fourth quarter, but if you compare the first quarter of both previous years, we'll see that we were reaching 9%. With a portfolio of 5.3. So now we grew our portfolio a lot and our over 90s a lot lower. So that's a major improvement in the quality of our credit. And we had a more conservative approach ever since last year, but it's always a concern, maybe one of the biggest actually, that the macro scenario could cause to our business. And one of them is direct, which is the financial expenses automatically, but we have another two. One is delinquency and consumption reduction, but we've been keeping our eyes open to these different trends, and that's why the understanding of this journey in the economy and where we're headed is really important, and we have to have this ongoing process of analysis. Very clear. Thank you for the answers. Thank you, Dani. Next question comes from Vitor at Santander. Vitor, you may proceed. Good afternoon, Renata. Elcio, thanks for the questions. First, about the sales in the first quarter. And if you imagine there's going to be a recurring in the next quarters, and there's a slight drop in the buy now, pay later in the brick and mortar stores, but from a nominal perspective, there was growth due to digital. But I want to understand a bit of your strategy to ramp up this in digital, and also the aspects of NPL and other points. Sorry, his audio is very low. We missed a few parts of his question. Well, for the company has this brand strength and commercial scale, logistics and sales force, and this allows us to reinforce our differentials in moments with high seasonality. The challenge is, after 2 years here, I see we must be aware of this business and retail. First, it's really big and complex. If you have a strong initiative that's more isolated, sometimes it's expensive and it doesn't bring in the results you want. So you must sell like 110, 120 million per day. If you sell 10 million less after 30 days, it's 300 million reais. So 500,000 per hour of difference is super concerning. You have to keep an eye open to every real and each consumer at your store. So initiatives must be organized and they must involve all departments in the company. Unit of stock, payment conditions, and really guarantee the margins at the end. So then you can see what the margin's going to be like, and that's where we really try to help deliver credibility gains. Well, having said that, yes, special sales are always going to be strong. All dates that are seasonal, we plan to differentiate ourselves with the share, capturing demand and operational leverage in the company. Looking ahead, Mother's Day is super strong for us, and we've been executing this very well. We prepared for this. We were very happy with what we've been delivering, and this is going to contribute to positive results in the second quarter. And the next strong retail date is going to be Black Friday. So besides this, we have June, July, August, September, and October, with about 5 months to create other strong dates and opportunities regionally as well, and really continue to encourage demand and grow. Now moving on to the second question on the buy now, pay later in digital. We've been growing our model, and especially we have a challenge to communicate that we have available credit for digital. The buy now, pay later consumer is so used to only approving this in the physical store. So he goes to the store and he doesn't know it's online. So I need to communicate this as well, right? So e-commerce in 5,000 cities, but I'm only present in 500 cities. So to look in the entire potential of pre-approved customers, I need to interact with them. And we have a big project, which is our CRM, one of our selective bets for the company. We have invested a lot. It's included in the CapEx we're working on. And we can use and optimize all of the results. And we reached 116 million customers so far. 45 million, I interact with these customers. I need to understand what's the consumer occasion, what's the best way to communicate with them, and customize the initiatives for each type of customer I have. We've been evolving a lot, and I think it's one of the projects that's most delivering the results and pilot projects in the initial phases that are very promising, but it's a project like for the midterm, not short term, and we'll bring this in gradually. But we do hope to deliver an increment in this penetration in digital every quarter, just as the other indicators, without any like magic, but just growing gradually. So the percentage for NPL is in line with our plan absolute volumes. As I grow my portfolio, it grows as well. But we plan to continue with the net loss that's lower than 5.4. If we look at the peaks in seasonality, it'll add up to about 18 a year. We normally charge like 9% a month on average. If you look at the full year, it's about more than 100%. We remove the funding costs, and it's still pretty good profitability. And additionally, you have the commercial margin and the services margin, with penetration reaching about 85% of the buy now, pay later. So that leads to recurrence, right? This is one of the rules that most converts, right? And we can continue this routine. So it's kind of like what we've looked at up ahead. No surprises, no peaks from one point to another, with incremental improvements contributing to the transformation plan. Well, even with the over 90 indicator, we're better in this percentage than the two prior years. And when we look at this digital, we see there's a addressable market that's really curious, and it demonstrates the strength of our buy now, pay later in Brazil. And not to mention, we have like 500 and some cities where we're present. Brazil has about 5,500 cities all over. So we have over 90% of the cities that have at least one person that has like a buy now, pay later. So either because they've left their city and they went to buy in another city where they have stores. And this is a important asset, despite something that's already traditional and popular. We have a lot to grow gradually and consistently. And I think the granting of credit is certainly a key point. So there's a lot to continue to advance with in the sales penetration over time. Okay, thank you, Vitor. Our next question comes from Irma at Goldman Sachs. Irma, please, you may proceed. Hey guys, good afternoon. Thanks for the opportunity for this question here. Expenses were a positive impact and highlight in the last quarters. You were very careful on this growth. And if we could talk about more details on this, and maybe it's a moment for us to recover some growth as well. And if you're going to translate that into operational leverage, or if at some moment you want to maybe add a little more variable expenses or fixed expenses, etc. And then a second question is about the differential, so that you guys have, is especially for heavy duty items, some more difficult categories. So in the logistical network, I want to understand how you are looking at a possible update of how you could explore the differentials you have against other market competitors, and the different opportunities to monetize this still. Okay, thank you, Irma. Yeah, it's a moment where the increase in margin comes from the operational leverage. There's opportunities with expenses we can work on, of course, but we're still trying to find opportunities, but they're a lot more geared towards mitigating inflation than material gains in the company's SG&A. Most of the gains come from operational leverage, and we really need to gain share to be able to deliver transformation, but we don't consider demand growing. January was a little better than what we expected. There was a little growth, but February was in line, really flat. March was a little worse than what we imagined for demand. So we gained share with a little less revenue than expected. April was the same, and maybe a little worse, but in May we've been recovering the demand. We still don't have the closed market share for May to know what the market's like, but in May we've been doing pretty well, and when we close the month, we'll know if the market reacted, demand came around, or if we just gained a lot of share. Our plan is focused on gaining share to build the operational margin. Second, logistics question. There are a lot of challenges. We had to work on investments in technology so that the fulfillment for other players could be done. And with the technology we built back then, are for small items. So I can't capture all of this differential in our logistical network, which was an important differential for big products, which are not in our categories. So we had the forecast of entering May with the systemic evolution. Partially that worked. We've been piloting this and manually, but we'll still spend about 60 days to put this into practice and then really start thinking about exploring the full potential of our logistical infrastructure. So we understand the plan today is still on the table. We have some challenges. We'll have important logistics unleashing, and we've been speaking with potential investors that would actually like to invest now. We say now's not the moment. We want to deliver scale gains in this business unit and transform it into sustainable with the necessary investments to think about strategic levers. And we're still working on some things as we need to enter this expansion cycle stronger from next year onwards. Thank you very much. Thanks, Irma. Next question is from Iago at Genial. Iago, you may proceed. Thank you, Renato, Elcio, and Gabriel. Thanks for the opportunity of 3 here on our side. First is a follow-up on credit. Maybe try another approach. From a percentage view, we see an improvement in NPL as what it was 2 years ago, but we still notice evolution in the provision for up to 60 days, and then we're talking about seasonality as well. So we want to understand if this behavior was in line with what you expected, or if considering the concession strategy, and if not, what's the type of adjustment you've been working on to avoid this from contaminating the entire portfolio? So is it focused on some type of a profile of customers, some digital or physical channel? If you could give us some more details on this. Second question is about the 966 from CNN resolution, if it makes sense to adopt this resolution with a write-off of assets, and if you're already considering something like this to adapt the model, if this really becomes a reality up ahead. And the third question is about the cash flow. When you look at the forecast for the cash flow, trying to reach a break-even till 29, I understand that the working capital will have an important role, and I want to understand where the improvement will come from. In the stock levels, you've been operating about over 90 days. That's what we consider you've been able to operate really well. But thinking about suppliers, is there space for them to get back to the levels in 2021? What can you explain in regards to this? Well, we'll start off here, Iago, then we'll pass this on to Elcio. But first of all, about the credit, it's in line with what expected. Actually, we don't see a need for adjustments due to any red lights, but there's a point to provoke you on that, but we'd rather actually be conservative, which is we think there's space and a customer profile that we used to prove that we're not approving anymore to gain cash. But the problem is the risk if there's a macro change, because actually, if you look at customers that have delinquency, it's a little higher than the average we're delivering. I'm covering a higher spread. Returns are higher, and we're choosing to deliver lower returns, keeping delinquency indicators that are really healthy and attractive. So we have an FIDC that's operating with volumes that are a little better, growing a bit more. We've also been working with other interested parties and that's very attractive. And of course, the returns are already significant, so we've been choosing to keep delinquency, even though if this means giving up part of his returns. My question about this, and we decided to wait for an improvement in the macro scenario. The question is, are we leaving cash on the table? Just as banks do this when they don't grant credit, then I'm also leaving part of this to regional players. So there's significant returns, and that would contribute to the company's operational leverage. But we're only going to discuss this recovery when we feel the macro environment gets a little better. Because while it can get worse, I don't know where it's headed. So if I was sure it was going to be where it's at today, we could maybe have a bit more approval and sales, but I don't think it's going to get worse. I don't know if it's going to get worse. It could get worse though. And then we'll just give you a bit more color on the credit dynamic now. But we'll talk about the cash flow, and Elsie can then add on as well. Third place, the working capital dynamic is super important. We understand that the company needs to work with about 75 days of stock. And the ideal would be 70, but we still haven't been able to. Stock ended up a little higher, and in March it was worse than what we expected. So when we look at and since sales were a little better in February and March, then when you adjust the payments to April, that also adjusts the working capital dynamic 90 days after. So when we look at this after July and August, it'll be normal, but you have the working capital pressuring this a bit more. And for me, this is a temporary effect that is discretionary, and we've been demanding this as well. And that impacts the number as well. But we've impacted this. Now we're selling more in May, and we should try to control this. And we're trying to allow for this to work, right? So the biggest opportunity we have is to get the distribution right. We have an important movement in the company. And in every period, you're going to be able to get in and go deeper in certain areas. First, we were really adjusting the treasury. Then we got into operation. Then I was around the company for a year, and I entered commercial. So we got into technology, and now we're getting into logistics stronger. We performed adjustments, and we're integrating logistics more and more with company areas. We've already discussed this a few times. The company had a lot of silos, and we need to work with this in an integrated manner. The decisions in one area impact another, and we integrated logistics, and we're increasing granularity of the algorithms for distribution. We've been using AI to distribute and assort this to calculate the profoundness of each item, and we have a lot of opportunities for adjustments. So obviously, as we mature and we have more consistency in this, this all helps us to have more consistency. We also intend to deliver this in that contributes to the capital structure in a very relevant manner. Well, in regards to the resolution 4966 that you mentioned from the central bank, the company has already adopted, even before this publication, the methodology, which is really in line with IFRS 9, that talks about the expected loss concept. So I think that if you don't know this, yeah, it's a measurement for provision for bad debt credits, and you've already kind of provisioned this from a statistical perspective. So we already have all of this, and we're already doing this beforehand. So when we start talking about delinquency in the second quarter, that's because we've already been testing this and linking this to the other question. You can see the different models and correlations that are very strong. If it's delayed 1 day, 2 days, 10 days, there's already statistics that adherence is very strong. So the entire team of the buy now, pay later and credit, each category and product and region in Brazil or city has a different reality with the delinquency rates. So as you manage this, and the way you look at this forwardly is a daily process. You have new information, you update, and you test and you adjust, and this is ongoing. You don't wait for a committee to make a decision. This happens daily. So there are many different variables, and people manage and control this. There's categories we have more delinquency than others. So we clearly work on this mix in line with the commercial team and the buy now, pay later with the merchandise and products are kind of working hand in hand. So if I have a campaign for furniture, maybe I can offer the buy now, pay later a little stronger, looking at the delinquency profile in this public. So anyways, it's an ongoing exercise really, but we really kept a close eye on IFRS 9, and that's why we haven't had any changes to our methodology or policy for provisioning in the company. Thank you guys for the answers. Thank you there, Iago. Our next question is from Gustavo Fratini at Bank of America. Gustavo, please, you may proceed. Thanks, guys. Good afternoon, Renato, Elcio, and Gabriel. First, we would like to get your view on 1P. You've delivered growth that's very strong in physical stores, but 1P is still having a slight drop. And it's important to understand the drivers of this drop and if the second quarter could already be an inflection point. And the second question is if you could talk about the capital structure. I understand that we're getting closer to the terms the banks can convert debt into equity, but I would like to understand your scenarios. So you also have tax credits and you've improved EBITDA a lot, but now it's maybe time to consider the net debt a bit. So what would be the scenarios in your mind, and what do you see as a reasonable leverage now for the end of the year? Thank you. Great. Thank you for the questions. First of all, on 1P online, there's still a drop because it reduces the comparative base of non-core categories. So we had a lot of categories in the first quarter. We saw a lot of volume in the first quarter. And if you look at the dynamics in the second quarter, you'll see that even with small growth in 1P, we'll still be delivering growth that is relevant compared to last year because the base changes and you're having more penetration. So yes, you'll see this inflection point from now on, and we'll see this in 1P. The challenge in 1P is you may even have demand. If you look at the market, it's increased its penetration for e-commerce on physical stores. So last year, if you look at the average, it's about 52, 48, 52 online, 48 on physical stores. But now that was the breakdown. But our forecast in our category is about 1 percentage point migrating to e-commerce. I think that due to the size of the investments and a lot of the online, we might even migrate 2 percentage points this year. But it's hard to measure next year. This migration happens in all categories, especially lower ticket items, but in high categories, it also happens. The challenge is that it's really difficult to make money. It's easy to sell, but selling and not making money doesn't make sense, right? So our 1P is a channel that's complementary to guarantee our commercial scale, our leadership in core categories, and we really monitor market share. I'm not losing market share in e-commerce, but generalist platforms are getting share from other players. But no, That's fine. That's coming from there. No problem. We could even organize that better. But we don't see anything crazy. But we do see companies buying growth. Of course, these are occasional measures. What makes us even more confident about our strategy is that we see a bit more investments concentrated in categories, and in others, it becomes more spot. But the key driver for growth in the platforms is not the home appliance category, it's complementary. So we see other categories pushing this growth in e-commerce, and we've monitored this, but we treat this as a strategic channel that is very important for the operational leverage in the company. We don't plan to have stronger investments there. So of course, as we increase penetration in buy now, pay later, this will change our profitability and allow us to have more investments. That's going to measure things. So when we talk to the e-commerce business unit, we say, do you want to grow? So that's approved, right? We increase penetration of the buy now, pay later, and that's going to have more capital allocation. It's a very mathematical dynamic. It's not like, oh, it tastes more like this or more like that. Do you like e-commerce more or less? No, I like e-commerce, but I like cash and I'm paid to make money. So we need to have this kind of a discipline for capital allocation where we really see value creation. Second question here in this capital structure, we must reduce this leverage. We have a lot of space, and that's how we measure. We have to look, if you look at the anticipation of receivables, so the buy now, pay later grows according to the funding, but the point is that we have one side, which are the financial debts we want to reduce. And we have some lines with suppliers that should be the main business in the company. And structurally, when a supplier wants to anticipate an invoice, since we don't have a capital structure capacity, we allow other banks or financial agents to anticipate our invoice and charge interest. Part of this we pay the bill for, and part of the rest the guy pays the bills for. But that's impacting all of our company ecosystem, and this is where we must really consider our cash capturing our financial revenue, which will allow us to connect this to the working capital point. We have suppliers that even if it's with their capital costs, they can provide even more payment terms as well. So for them, there's a lot of value in this flexibility due to the working capital that exists in this market, especially for small and mediums. So there's a lot to happen, but that won't be short term. We must first reduce the financial debt, improve credit perception, and then reduce the spreads. We're paying really expensive spreads still. Even the funding for the buy now, pay later and anticipation has a space to be reduced. We already had good negotiations, and we still have room, especially in the longer installments, right? We anticipate 1 or 2 installments, and today, considering the company's reality, we need to anticipate everything. So we want to reach a point where we don't have to anticipate the others, and we can make decisions that value profitability more. So, and not only when we have to make decisions, because that's just the most important for the company to deliver transformation. This year, it's still going to be the case, but we hope to bring some news in the next quarters so that we can contribute with a new structure and lower leverage. And we also need to work with double digits and the financial expenses as well. So this will probably reach about 6 or 7 to have margins in the bottom line of the company, but we have a lot of work to get to this point still. Okay, very clear. Thank you. Thanks, Gustavo. Our next question is from Andrew, Morgan Stanley. He'll send the question in English and we'll be translating, okay?
Right. Thanks for fitting in the question here. On the third-party marketplace, so you're back to growth, and also we saw the take rate expanded. So I'm curious how you think about the take rate evolution from here, if that can become more of a driver of third-party profitability, any breakdown between kind of the core advertising, logistics fees to consider. And then just a quick follow-up on the capital structure. Sorry if I missed it, but is there anything to consider in terms of asset sales or monetization outside of the credits you've already discussed? Just curious if that could be another part of the deleverage path. Thank you.
So on 3P, the take rate is, our focus is to grow in core categories. And with that, negotiation's a lot better than, because I work with the direct consumers that I buy for 1P, and I prefer to have this item in 3P maybe for some other capital allocation matter. So we see space to keep it at this level. We're not pressuring an increase in this take rate at the moment, but our main challenge is delivering what we consider as logistics to increase fulfillment in our 3P. Our fulfillment is really low, and I don't have technology to have the big box there, which gets in the way a lot. And what we're talking about is the fulfillment, which is the same as all generalist marketplace platforms. And we're starting up the fulfillment of the big box of big items, refrigerators, furniture, and televisions, etc., which will provide profitability to 3P and our logistics. So this is our main transformation in 3P over this year, which will also provide more experience to customers. Because the delivery terms as I have today are not ideal, so conversion is also not ideal, but when I deliver the first lever, sales should increase a lot in 3P. So we see a potential for growth in 3P and core complementary categories with more fulfillment and profitability. It's a little higher, contributing to the fulfillment services as well. So that's what we're seeing again for 3P. On the issue with your other question, I think about monetization of the assets, etc. Well, just let me add one point to Andrew here. When I look at the first quarter, you see there's more contribution, especially from the buy now, pay later. So you have over 3,800 sellers registered to sell through our platform and our marketplace. So from percentage points, this was the biggest growth. Commissions also contributed, but the buy now, pay later was the main point. On monetizing assets, we have some real estate assets to sell as well, but sales leaseback assets, before we fix the capital structure, the yield is really high, so it really doesn't make sense. But we think the monetization of other assets will only occur after the evolution operation of the company and the improvement of the capital structure, reduction of financial expenses, and then the negotiation will be more reasonable and make more sense. Today, due to the team's execution, we don't need to have a deal that is good for the cash now, but bad in the long term. We're going to wait to improve the company a little more so that the risk perception about the company gets better, and we can make these monetization agreements of other assets in the company, because some of them are not going to be that significant, but when you add them all up, we do consider that there's maybe a few 100 million to bring into the company. We have no other questions now, so before wrapping up, I just want to thank everyone for their participation and wish them all a wonderful day. I want to wrap up just saying that there are 3 key messages. First, I want to thank everyone for having participated. We resumed our growth in the company. This quarter really sets the scene, which is so important. We are also more profitable and efficient every quarter, 6 quarters consecutively, and we're going to continue to have this commitment to improve profitability in every quarter. And the operations also, we've been very confident about it. And third, the net income turning point is set. We're aware of the challenges. We know about the macro environment. We know it could maybe be a little more pessimistic than the average, but in this scenario, we're going to reap the benefits of the operational leverage. We'll reduce our debt and work on the levers we have to improve capital structure, improve risk perceptions, and reduce spreads, reducing the financial expenses, and really so that next year we can have a turnover in the company's bottom line and have a new cycle for the company. Thank you all for your trust. Thank you for participating, and our department is also present and ready to answer. Thank you all. Have a great afternoon, and let's buy because we have a special sale active at the moment. Go and shop at our stores. Bye. Have a nice day.